Hello traders, the title of the video is learn how to avoid a common Elliott wave trading mistake like a pro. Alright, in this tutorial I want to highlight a common Elliott wave trading mistakes one must avoid like a professional trader. Alright, let's begin the demonstration. Alright, so I have here, I'm looking at Symantec. So if you are using computers, alright, talking about various software to protect your computer. Symantec belonging to the technology sector, software application. This is an American store that belongs to the technology sector. So I have counted wave here before, so if you remember, all right, so this is the first area wave right there. All right, I'll color it now into orange, okay, followed by this double bottom here. This is the second wave on the monthly chart. I'm on the monthly chart. First wave, second wave in the shape of 1, 2, 3, forming a double bottom chart pattern. And then we have a complex third wave. I don't want to dwell on it from here all the way up here. So first wave ending here, second wave ending right there, and the third area wave ending here, followed by the fourth wave ending right there, and now we have the fifth area wave. So we have now a multi-wave, and we do not have any area wave violation. So where I'm putting my vertical line, so between the two vertical lines, we have first wave, second wave, third wave, fourth wave, and the fifth wave. And then the correction is beginning in this section here. Now, what usually takes place after we counter the 5 wave and the correction is underway, a lot of financial market traders will apply Fibonacci retracement to the multi-wave. All right, hold on please. All right. They will apply Fibonacci retracement to the multi-wave, so from here all the way to the top here, and they will highlight the zone of 50% and the 61.8% Fibonacci retracement level. So those are the two lines there. I will talk about it very soon. I don't like to do it like this. I'll show you why in a minute. All right. So trader will apply Fibonacci retracement, to the multi-wave, and they will watch the zone between the 50% and the 61.8% Fibonacci retracement level. So usually there are orders here to buy after the price pull back into this zone. And the common trading mistake that traders are making, they will start counting wave as soon as the price finds support in a zone of 50% and 61.8% level. So here we have again a kind of a double bottom. All right. So trader will start in fact again a triple bottom here, because the price pull back again here, you see here. So in fact, trader will start counting wave from here. All right. So suppose you are here, so you say, okay, now the correction has finished. You assume that the correction has finished. You start counting wave. You say first wave, second wave. You can see that there was a cancellation here. All right. So if there is a cancellation, because you see, if you call this one the first wave, the new first wave, and now you see that the new second wave is almost coming to the beginning. So you may say, okay, Joe, you did not cancel it. So you say, all right, Joe, this is the second new wave. So you say first new area wave, color it now into red, and the second new wave, 1, 2, 3, and now you are expecting the third area wave to continue in this section. All right, this is a common area wave trading mistake. I'm not saying that the third wave cannot continue like this, but what I do care about is that when we see the multi-wave like this and then the price pull back, all right, especially if you're on a monthly chart, it will be better to go to the yearly chart, all right, to apply what we call the infinity of the area wave principle. But if you stop on a monthly chart, you start counting wave like this, you can be in trouble. All right. So now we see 5 waves. It pulled back to the 50% Fibonacci between the 50% and 61.8% Fibonacci retracement level, and then you start counting wave on the monthly chart like this. Very often, this can lead traders into trading mistakes. All right. So to avoid that, so you can't wave on a monthly chart like this, and you are assuming that a new cycle is about to begin. Please do me a favor, go to the yearly chart to see the bigger picture. Now that we are on a yearly chart, so our multi-way is still between the two vertical lines here. You can see that on the yearly chart it's becoming a little bit clearer to us. The price pulled back. Now it start going up in this session. All right. So probably if you were looking on the yearly chart, I want to remove my Fibonacci retracement. So now that you come on the yearly chart, now you may say, all right, George, in fact, the first wave is not from here. Hold on, please. Stay with me, please, because you take some time before things will become clearer to you. So you go to the yearly chart, you'll be saying probably this is the first wave from here. You may not say from here because of the price pullback. So it's the first wave from here to here, and this is the second wave. So on the yearly chart, you call this one. So again, it's all right. Still the same, it's all right. So on the yearly chart, you say, all right, the correction is now finished. You say first wave, 1, 2, 3, all right. So you will see second wave, and you'll be expecting, okay, the third wave here, all right. But it is this kind of, style of trading, or this kind of style of using the area wave can lead traders into a mistake, all right. So to avoid that common area wave trading mistake, what you need to do, anytime, all right, you have counted 5 waves on any time frame, you need to apply the Fibonacci, extension to that multi-wave. All right, so you apply Fibonacci extension to that multi-wave, and you want to highlight the 138.2% Fibonacci retracement level. So that the line that I'm going to color now into pink is the 138.2% Fibonacci extension level to the prior multi-wave. All right. Now, before we continue, I want to show you something very quickly that I always do because of my personal experience. Now, I don't want to, so you can see that my Fibonacci extension, I didn't bring it all the way to the top here because I use the yearly chart. Okay, here it is. Look carefully. Though the multi-wave has ended here, when I was drawing my Fibonacci extension this time on the yearly chart, I started from here. You see, from the low to the closing price. I didn't go to the high. All right. But if you were drawing the Fibonacci, okay, hold on, please, traders. Moment, please. What I'm trying to say here is that if you move some of my line, okay, all right, okay. If I move my vertical line, this one here on the yearly chart, look carefully. You can see that on the yearly chart, this candlestick bar got a shadow on top of it, all right? So in this case, as I'm on the yearly chart, I don't want to put my Fibonacci extension all the way to the top of the shadow, all right? So this is something you need to be aware of, all right? So I want to put it at the closing price. That's what I'm doing now. That's what I'm trying to explain to you, okay? Though on the, all right, on the monthly chart, we will be tempted to put it at the top. But now that we're on the yearly chart, the price did go to that point, but it was sold back down and closed here. So I would prefer to place my Fibonacci extension here. I talk about it at dayprotrader.com when I was explaining to traders that not all traders draw their Fibonacci extension the same way. So in this case, I ignore the shadow and put it at the closing price. By doing so, my 138.2% is the pink line right there. So to avoid that common common area wave trading mistake, whenever we counted, okay, I'm going to place back my vertical line right there. Whenever we counted 5 waves, whenever we identify a multi-wave, and there is a correction, and we want to start counting, okay, a new wave. So we start thinking that a new trend is about to begin, and we start counting wave. As I'm showing you here, you see first wave, second wave, and now you are thinking that, okay, the third wave will begin. The reason why I'm saying this is that when in the financial market, when we have a multi-wave and the price pull back into the zone of 50% and the 61.8% Fibonacci retracement level, there are usually orders there to buy. And most market participants will expect a new trend. Do not get fooled with that, because you are nearly a wave trader and you don't want to get into that kind of trading style when you start counting wave and forgetting the 138.2% level. So as things stand now, so suppose you were here, you start counting wave here, one, a second wave, and you're expecting a third area wave here. What you need to do to avoid that kind of mistake, counting a new wave for a new multi-wave, all right? Before you can assume that a new trend is now underway, the price must break above the 138.2% Fibonacci extension level of the prior trend. So now, as we are here, you see first wave, second wave, and you're expecting a third area wave, you must put a big question mark on your new waves that you are counting here. That's all. If you are counting area wave, you see a multi-wave and a correction, and you start counting a new wave like this, or you forget about, okay, what has happened before, most importantly, you forget the 138.2% Fibonacci, right, extension level of the prior multi-wave, you will get quickly into trouble. And you don't want to do that. Sometimes you may see a clear cut 1, 2, 3, 4, 5 wave all the way up to the 138.2% level, but if the price did not go above that 138.2% Fibonacci extension level of the prior trend, we cannot certify that a new trend is underway. All right? You need to remember that, and you don't want to forget it, because you are an area wave trader and you want to understand the price structure. A new multi-wave must be above, okay, the 138.2% level. So as things stand now, you see first wave, second wave. If this price action found a resistance there, we cannot call it a new trend, even if we see 1, 2, 3, 4, 5 wave all the way here. So if you are here and you're expecting your third area wave, the best place to catch that supposed to be third area wave should be above the 138.2% Fibonacci, okay, extension level of the prior multi-wave. All right, so those who are counting wave right here now, saying that this is the third area wave, must put a question mark on that third area wave, and with only we only accept it as the third area wave if the price continues to go up above the 138.2% Fibonacci extension level of the prior multi-wave. All right, so let's go back again to the monthly chart, and you'll see it will become a little bit clearer to you, because we don't want you to be, okay, doing those kind of things. All right, so here you see 1, 2, 3, 4, 5 waves right here, and blah 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 blah. For many years, you see from 2005, the price still correcting itself. Now people say, oh, right now a new trend is underway. This is the first wave, this is the second wave. Now we are now in the third area wave. Maybe, all right. That remains to be seen. So far, we can only put a question mark on it, but you need to be careful if you are counting wave below the 138.2% Fibonacci extension level of the prior, okay, multi-wave. All right. So most importantly, in this tutorial, what I've said to you before, you count the wave on a monthly chart. You want to apply Fibonacci extension to that, okay, multi-wave. Please always go to the yearly chart to see, okay, what is happening there. And if you got a shadow, all right, ignore. In my own trading style, I always ignore when I'm using the Fibonacci extension like this for area wave count. I will ignore the shadow in this case, so that I may use a conservative 138.2% Fibonacci extension level. That's one thing you don't want to ignore. So if you were on a monthly chart, you will apply it all the way to the top, which is wrong. But if you come to the yearly chart, you see that it got a shadow. Practically, one should ignore the shadow and apply the Fibonacci extension to the closing price and highlight it there. And second thing, if you are counting the way below that 138.2% Fibonacci extension level, it's very, very important to be very, very careful because the price may find a resistance there. Another reason why you need to be careful when you are counting a new multi-way, you are counting wave and new, you are trying to catch a new trend below that 138.2% Fibonacci extension level of the prior multi-wave. Another reason is because of the flat correction. All right. So though it looks like a new trend is underway, it may just be a next wave, X wave, or the B wave of the flat correction. So multi-wave 1, 2, 3. And now we have again price may go up to the 138.2% Fibonacci extension level, find a resistance there at the time when everybody is thinking that a new trend is underway, or in this case you're expecting a third in your wave. You may be dealing with a flat correction, and the price may come down 1, 2, 3, 4, 5. Which is very bad because a lot of people right now are buying this stock expecting it to go up more to form a new multi-wave. But if they ignore that 138.2% Fibonacci extension level of the prior multi-wave, as I show you now, they will be in for a big surprise when the price is rolling it back down in the shape of 1, 2, 3, 4, 5, completing the expanded flat correction. We know that the expanded flat correction, the B wave of the flat correction, will bring the price back above the high of the prior multi-wave, only to come back down, forming the C part of the expanded flat correction, 1, 2, 3, 4, 5. This is a common area with trading mistake. Sometimes the reason why traders are falling into that trap is because, for instance, let's go back to the monthly chart. All right, I think this is an essential tutorial and I need to mention it so traders may know about it. So suppose you are here, sometimes because some traders do not have enough data, all right, so they do not have enough data, probably they may not see everything, all right, so they may only see something like this on their chart. So if they don't have enough data, so they only look at this on the monthly chart. So they say, all right, George said that there is a consolidation. Now we see a breakout, which is the signature of the bull. Now we see 1, 2, 3, because they don't know. They are not looking at everything. They see only this on their chart because their broker do not provide enough data for them. They only see, they say, all right, this is the first wave, 1, 2, 3, the second wave, and they're expecting to catch the third in your wave, and they don't know that there's 138.2% Fibonacci extension level of the prior multi-wave. All right, so two things very important. Ignore the shadow if you see on the yearly chart. All right, very important on the yearly chart. Repeat, on the yearly chart, if you see the shadow on top, ignore it if you apply the Fibonacci extension to highlight the 138.2% level. If you are counting a new wave during a new multi-wave, be aware of the 138.2% Fibonacci extension level of the prior multi-wave. The reason is the price may change direction at the 138.2% level and form a flat correction. You may think that, oh, George, if we have a multi-wave, the correction has been here for many years. Now a new trend is underway, and we are now in the third area wave. But maybe you are just in the B wave of a flat correction that is waiting, to form the C part of that expanded flat correction. All right. So my recommendation, traders, see enough data. All right. So I say to traders, you want to see at least the yearly chart. So I'm using here TC2000. You want to see the yearly chart, very, very important. So you may see the bigger picture. If you were only looking at the monthly chart, if you could not see the yearly chart, you would have applied, so in that case, you would have applied your Fibonacci extension all the way to the top, all right, all the way to the top here, and you will have your 138.2% at the red line here, instead of here. Now, you see, so your 138.2, if you apply all the way to the top of the monthly chart because you don't have the yearly chart, your 138.2% will be here, which is completely useless. All right, completely useless. But now that if you have the yearly chart, which I recommend that you have, all right, okay, you will see that it got a shadow, and you apply it to the closing price. Now you have a valid 138.2%, and you see the reaction on the price as the price was approaching that level. Okay, let's go back again to the monthly chart, and you see how the price came near that level. Okay, the pink line of that. Okay. Which is the 138.2% Fibonacci extension level of the prior multi-wave. All right, so this is just a shout out about okay, a common Elliott wave trading mistake that one must avoid. Okay, all right, so watch it again, understand everything, and don't forget it. It has something to do with the video that I recorded recently. The title of that video was how to master the infinity of the Elliott wave, a principle. Very often, traders do not have enough data, and sometimes with the information that they have on their chart, they count their wave like this, and they are missing some information, and they get into trouble, and they wonder why their wave count is not working. Another thing I want to say to you, a lot of market participants that are not fluent, that do not understand, that do not master the Elliott wave principle, very often, you need to be aware of those traders also, because anytime they see a multi-wave and the price pull back to the 50%, 61.8% Fibonacci retracement level, they will just buy, expecting a new trend. Here they buy, you see, now it's in profit for them, it's going up, but it's not yet a trend as such. That's all. All right, as an Elliott wave trader, you don't want to repeat those mistakes because you know more. All right, you understand the price structure. You know that if the price breaks above, okay, the high of the multi-wave, the next resistance is 138.2% Fibonacci extension level. All right, and also you want to discount the shadow above on the yearly chart. Okay, if you apply in, very important. In fact, if you apply Fibonacci extension in an uptrend, I would prefer that trader ignore the shadow and put it at the closing price, or apply both. So if you want to, you can apply at the closing price. You have the pink line, and also apply it to the top, and then you have the red line, so you are aware of it also. All right. Very, very important video, okay, a warning that you don't want to repeat. This is about learn how to avoid a common, wave trading, Elliott wave trading mistake like a pro, all right? If you have any question or suggestion, put in a comment section, and in due course, I will be recording another video, to answer your specific question. What I want trader to do, if you want to ask a question relating to a specific video, just try to refresh my memory. Say, Joe, you said this in that video, and I want to ask a question about this. That will refresh my memory, so I will know exactly, what you are referring to. As I'm recording more video, I may not know exactly what your question is relating to. All right. If you find this video useful, all right, let us know by giving us a signal. Give us the thumbs up. You think that, Joe, this is another useless video, all right, let us know by giving us the thumbs down. All right. But if you think that this is an essential tutorial for all Elliott wave traders that want to avoid this common Elliott wave trading mistake, feel free, all right, to share it on Google+, on Twitter, and also on Facebook. Until the next time, enjoy yourself and be very happy. We are the TSTW24 traders talking about learn how to avoid a common Elliott wave trading mistake like a pro. Happy trading to you all, and speak to you soon.